My name is Raymond, and I'm going to be taking you for this webinar on IFRS for SMEs, the 2015 version. You will be aware that the initial version of the standard was issued back in 2009 and has been in existence and application since then. This version of the standard is a replacement version to that initial version and takes into consideration some of the comments that have been made by users based on the experiences with the original version of the standard. This version of the standard was issued back in May of 2015, and like I said, it was the first revision since the standard was originally issued. What the ISB have done over the years is they've undertaken extensive consultations and have undergone information gathering in order for them to arrive at this version of the standard which has now been issued. The findings that came out of the consultation period showed a few things. The standard was working well, but there were some improvements that were required that could be made in order to make it work better. The standard required more accounting policy options. When you look at what we have under full IFRS and what we have under IFRS for SMEs, sometimes there were areas in IFRS for SMEs that could do with alternative accounting treatments, which in some cases have now been incorporated. IFRS for SMEs had a fairly complicated taxation section, and what they've now done is they've aligned the taxation treatment with that which is sitting in full IFRS. And sometimes the standard lacked additional guidance in order to assist with the application of the words that were included in it. So all of this has been, to some extent, been taken into consideration in arriving at the version of the standard that we currently have. In total, 56 changes were made to the standards. A lot of them were new and revised IFRSs, which were brought into play. There were changes that were made based on just wording that needed to change in the standard to make it read better. There were some clarifications, a significant number of these were minor clarifications to wording, new guidance that was incorporated, additional disclosures that have now been brought in, some exemptions as well that have now been brought in when it comes to the first time adoption of the standard. And they've also brought in some of the Q&As that were issued by the SME implementation group. These now form part and parcel of the standard. You'll be aware that the SME implementation group Q&As are not mandatory, but the minute they make up part of the standard, they become mandatory. So some of these things have now been brought into play into the standard. The principles that have been applied in the entire process of setting the standard in the manner in which it has been set is that the ISB have gone through a process where they've looked at what is sitting in the current version of the standard, what has changed about IFRS, full IFRS, the big standard, and in a way they've tried to make sure that they've aligned the requirements that are sitting in full IFRS with the requirements that are sitting in IFRS for SMEs, but at the same time trying to make sure that they create a stable platform in IFRS for SMEs that will still be suitable for application by SME type entities. So when one looks at the major themes of the amendments that have been made, there's been the introduction of additional accounting policies, so additional choices like I mentioned earlier on. There have been some changes and clarifications to current requirements. They've also added in additional undue cost or effort exemptions. We'll go through these and what these mean. And they've also provided additional exemptions to reflect some of the exemptions that are available under full IFRS and the application of some sections of the standard, specifically around first-time adoption of the standard. So when one looks at what has changed about this version of the standard from where we were before, there have been amendments to the scope section, to the concepts and pervasive principles, the preparation or the presentation of the statement of financial position and the statement of comprehensive income, as well as the statement of changes in equity, how we deal with consolidated and separate financial statements, and how we craft our accounting policies and deal with estimates and errors where they occur, what happens when you have business combinations, specifically around goodwill, and how that is dealt with, where you can't separate goodwill from intangible assets. They've also provided us with some guidance on liabilities and equity, share-based payments. Additional guidance has been provided here, specifically for share-based payments where one cannot necessarily identify the compensation that one is getting. Additional disclosure requirements related to related parties. Intangible assets are also dealt with. Financial instruments, associates and joint ventures where you've got such investments. Property, plant and equipment. I think for a lot of us, the questions were asked before around, well, why can't I revalue property, plant and equipment? Well, now we can. Investment property, leases, income taxes I've mentioned already. Provisions and contingencies have been addressed as well, as have impairment of assets, employee benefits, specialized activities, and then the whole process of transitioning onto IFRS for SMEs. Foreign currency translations as well have been dealt with, and there have been some amendments to the glossary, adding additional definitions to make sure that whatever it is that we're doing, we're working with the appropriate definitions of those items. So the amendments that have been made, in a lot of cases, are minor amendments to IFRSs that have not been brought into IFRS for SMEs. The intention being to provide clarity or simplification on particular matters, and in some instances the intention has also been to fix diversity that has occurred in practice when it comes to people applying the concepts that are dealt with in IFRS for SMEs. There are a few areas where there have been changes in full IFRS, but those changes have not been carried forward to IFRS for SMEs. Take for instance, we have a new version of IFRS 3. Well, no longer new at this point in time, it's 10 years old. IFRS 3 was amended in 2008, and some of those amendments, or those amendments that were made in 2008, have not been carried forward into IFRS for SMEs. IFRS 9, the new financial instrument standard, none of the wording or none of the guidance that is provided for in IFRS 9 has been carried into IFRS for SMEs at all. Neither have the changes that IFRS 10, 11, 12, or IFRS 13. None of those standards have had any impact whatsoever on what we have in IFRS for SMEs. IAS 19 was amended back in 2011, and there was a change to the defined benefit accounting that is provided for in that standard. None of that has been taken into consideration in IFRS for SMEs. There's also the changes that are currently happening and changes that are mooted on the conceptual framework. None of those have been taken into consideration either in this version of the standard. So just to reiterate, the new financial instrument standard will not be taken into consideration in IFRS for SMEs. Neither will the new revenue standard IFRS 15. The new leases standard, that will not have any impact either. So at this point in time, what is currently sitting in IFRS for SMEs, the 2015 version, will remain in force for the next however long until the next version of the standard is issued. It is anticipated that this will probably happen in about 2021, 2022. But again, the ISB will go through a similar process as they did in 2012, where there will be consultation and there will be some request for information from users of the standard and users of the financial statements that are prepared under the standard to understand what is working and what is not working. I mentioned that there have been some changes to the glossary, additions that have been made to the glossary. The term active market is now defined, as is a close member of a family of a person who is deemed to be a related party. Foreign operations are also defined, as are minimum lease payments and transaction costs when it comes to any transactions that that an SME reporter may enter into. What we'll do now is we'll talk through section by section where there have been changes that have been made to the standard, and talk specifically through the changes that have been made to the standard and how they are likely to have an impact on the accounting that is to be applied. So we'll start off by having a look at the scope section of the standard. When one looks at the definition of what an SME is, this has been pretty straightforward. Nothing has changed about this definition. An SME is an entity which does not have any public accountability, and an entity is deemed to have public accountability if it has instruments, equity instruments that are publicly traded, or it has debt instruments that are publicly traded, listed on a stock exchange, or if it happens to hold assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. The 2009 version of the standard then went on to list banks, credit unions, insurance companies, security brokers and dealers, mutual funds and investment banks as a sort of entities that would probably meet the definition of an entity that holds assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. What the 2015 version of the standard has done is that it has clarified that the fact that these entities are listed in the standard does not necessarily mean that they have public accountability. You could find that you have an insurance company that has been set up specifically to address the insurance needs of a limited group of users. So in that scenario, even though it's an insurance company, it does not necessarily mean that it has public accountability. So therefore, it could choose to apply this standard. Moving on to the concepts and pervasive principles that the standard addresses. One of the key matters that has been addressed in the standard is the concept of undue cost or effort. The undue cost or effort exemption, which we are permitted to apply in terms of the standard, is an exemption that is available only in specific circumstances. It's not to be applied willy-nilly. It's not to be applied in pretty much any situation where one feels that applying the standard to the T may be onerous or may not be achievable without too much effort. Determining whether or not the undue cost or effort principle applies depends on the specific circumstances that the organization finds itself faced with, and it also must take into consideration management's judgment of the costs and the benefits that will result from the application of the requirement. Now, when one looks at what we mean by this, consideration of cost or effort is from the perspective of the organization, whereas the consideration of the benefits must be looked at from the perspective of the people that are going to use these financial statements that are prepared by the company. Now, this assessment is not we make the assessment today and that's the end of that. It must be done at initial recognition when the principle is initially applied, and it must be constantly revisited at each subsequent reporting date to see whether or not it's still applicable. And to the extent that it is not, then one must go back and must make sure that whatever the accounting that should have been applied is applied to the T. Where an organization does apply the undue cost or effort exemption, then the organization would be required to disclose the reasons why it has applied this exemption. Previously, one could simply apply the exemption and that would be the end of that. But now with the requirement to provide reasons as to why the exemption has been applied, it will make the financial statements, understanding the financial statements, that much more clear. Moving on to the statement of financial position. There have been a few changes that have been made around the way that we recognize and measure certain items that feature on our statement of financial position. The first thing is around investment property. Investment property that is carried at cost less accumulated depreciation and impairment must be presented on the face of the statement of financial position separately. Previously, any items that were shown, any items of investment property that were shown at cost less accumulated depreciation and impairment was treated as if they were part of property, plant and equipment and presented as such. Going forward, you'll show a separate line item for these sort of items. Something else that has changed on the statement of financial position presentation is our disclosure around share capital. Where an organization has share capital, normally you'll be required to disclose a reconciliation of the opening and closing share capital for each class of share that is held or that is in issue. No reconciliation disclosure is required for the comparative period. So should you choose to provide it, that'll be fine, that'll be up to you, but there's no requirement in the standard itself for that comparative disclosure to be shown. Moving on to the statement of comprehensive income. You'll recall that the statement of comprehensive income, specifically the other comprehensive income section of that document, included only 3 items previously that were recognized outside of profit or loss. So generally all items of income and expenditure that an organization earns or incurs are shown as part of profit or loss, with the exceptions that we had before being foreign currency translation reserves, actuarial gains or losses on defined benefit plans, and cash flow hedge gains or losses where these existed and they were deemed to be effective. What is now new arises from the fact that we are permitted to revalue property, plant and equipment, and any revaluation surplus or deficit that arises from such revaluation is taken to other comprehensive income as well. So now looking at the items of other comprehensive income that we have and their treatment, we'll be required to show separately in our statement of other comprehensive income any changes in foreign currency translation reserves, actuarial gains or losses on defined benefit plans, cash flow hedges and revaluations of revaluation surpluses and deficits from property, plant and equipment. However, just to reiterate, only cash flow hedge gains or losses are recycled. The other 3 are never recycled. You might move them from one reserve to the next when they're no longer they're no longer in use, but there's no recycling that will ever impact your profit or loss at a point at which property, plant and equipment is disposed of, or an actuarial or defined benefit plan is curtailed, or we dispose of a foreign subsidiary. The foreign subsidiary one will be very unlike what we have in full IFRS, which requires that there be a recycling of those gains or losses impacting profit or loss in the year in which that happens. Moving on to the consolidated and separate financial statements that an organization may prepare. Specifically around consolidation, where an organization controls another organization, it is required to prepare consolidated financial statements in which all of its subsidiary companies are consolidated. However, such an organization is exempt from preparing consolidated financial statements if it meets the 2 criteria that we have here. If it happens to be a subsidiary of another organization and the ultimate parent or a parent above it in its group structure somewhere prepares consolidated financial statements either in terms of IFRS or IFRS for SMEs. If it does that, then you may be exempt, but you need to make sure that both criteria are met. So the issues that are then arise that are addressed in the revised version of the standard are what happens where an entity acquires another entity, but the intention is that it will sell this entity that it has recently acquired within the next 12 months. If that is the case, then section 11 of the standard comes into play. That's the financial instruments section of the standard. And the standard simply requires that the accounting that is applied for that investment in this new subsidiary company be measured in terms of section 11. If it then so happens that after 12 months the entity still controls the subsidiary, it will then be required to consolidate the subsidiary company from the original acquisition date, not from the point at which the 12 months is achieved, from the point at which the subsidiary company was originally acquired. So that may then mean it may need to go back and restate prior period financial statements. If it still controls the subsidiary company, but it remains committed to disposing of it, and the only reason why it has not yet disposed of it is because of circumstances that are beyond its control, then the entity continues to apply section 11. So you continue to recognize and measure that investment in that subsidiary company in terms of section 11. That's effectively at fair value. In the preparation of the organization's separate financial statements, the standard does not require a parent entity to present separate financial statements unless it is required to do so by local requirements. So legislation comes into play here, and you'll find that in some jurisdictions, legislation will simply state that financial statements must be prepared in terms of what the requirements of IFRS are. And if there is no requirement, and as IFRS does not necessarily mandate the preparation of separate financial statements, then there may not be a need for you to prepare a set of numbers, separate set of numbers. So you need to have a look at that from your own perspective. However, if you are required to prepare a separate set of financial statements, then we now have one of three ways of dealing with such investments. Remember, these investments may be investments in subsidiary companies, in associate companies, in jointly controlled entities. And the standard says we can go fair value, we can go cost, or you could apply the equity method. It would be up to you. Consistency would then be the trick that you need to make sure you apply going forward. Moving on to accounting policies, estimates and errors. We'll all be aware that once an organization selects an accounting policy, that accounting policy must be applied consistently going forward. The only time that an organization would be permitted to go and make a change to its accounting policy, its selected accounting policy, is if it turns out that the application of that particular accounting policy is next to impossible, was unachievable in the company's circumstances, is not result in, or the change in the accounting policy will result in more relevant and reliable information for the users of the financial statements, then an exception can be made. Sometimes standards allow for a change to be made on a voluntary basis. A voluntary change of accounting policies is required to be applied retrospectively, unless it is impracticable for you to go back and restate prior period numbers. And going back and applying a standard retrospectively, it would then mean that I'm going back to the beginning of my comparative period, making changes to those numbers, making changes to last year's numbers as well, my comparative period, and then the impact will then cascade into my current year numbers. If the standard itself has been amended, then chances are there will be transitional provisions that will be provided for in the standard, as we have in this particular standard. Section 35 will then lay out, because we've had all these changes that have happened to the standard, how do we go about applying them going forward. But you'll probably find that in a lot of cases They will, in order to make sure that there's consistency of presentation, consistency of measurement, that the changes will be required to be on a retrospective basis. However, in some instances, the standard will allow you to apply the changes that have been made on a prospective basis. And specific case in point is the change in policy that allows the property, plant and equipment to be carried at revaluation, and that particular accounting policy change will be applied on a prospective basis. Moving on to financial instruments. We have two sections in IFRS for SMEs that address financial instruments. Section 11 that deals with basic financial instruments. Section 12 that deals with other financial instruments, the more complicated ones. And then for those of us who've got the really complicated financial instruments on our financial statements, and what we have in sections 11 and 12 does not address what we're doing, then we're permitted to fall back on IAS 39. But this will be an accounting policy choice that we're making in applying what is sitting in IAS 39. Earlier on I spoke about the fact that IFRS 9 is coming into play. It's effective January 2018. And once IFRS 9 becomes effective, IAS 39 will effectively cease to exist. However, the wording that we have in IFRS for SMEs that refers us back into IAS 39, that will remain as is. What the IASB have done in issuing this version of the standard is they've clarified that we will be required, if we make the choice to apply IAS 39 as an accounting policy basis, then we'll be required to apply the latest version of IAS 39 that is effective at the reporting date. So after IFRS 9 becomes effective, an organization that elects to apply IAS 39 will be required to apply the last approved version of IAS 39. That version will then be frozen in time effectively, and there will be no more changes that will then happen to that version of the standard going forward until such time that the IASB decide to make a change. But for now, we continue to apply IAS 39. There will not be an option to adopt IFRS 9 for entities that apply IFRS for SMEs. Delving a little deeper into what we have in this section that deals with financial instruments. It addresses what a basic financial instrument is, and it gives us examples of the typical items that would meet the criteria for classification as basic financial instruments: cash, debt instruments, loan commitments, non-convertible preference shares, non-puttable ordinary shares, those sort of things. Now, the general measurement basis of such financial instruments will be that they're carried at cost, with the exception of preference shares and ordinary shares that are publicly traded or whose fair value can be measured without undue cost or effort. Now, folks, we're bringing in that whole concept of undue cost or effort into the sums here, and you'll see that the standards will specifically deal with or bring in the concept of undue cost or effort, and without the standard making mention of it, we can't then take the view that says, well, because it's going to cost us too much money, so therefore, or entail too much time on our part, so therefore we will apply the undue cost or effort exemption. Can't do that. We would be required to apply the standard to the T as required. So measuring our basic financial instruments, initial measurement is always based on the transaction price, including any transaction costs, except where we've got our financial instruments that are measured at fair value through profit or loss, where we exclude any transaction costs. But that's similar to what we have in IAS 39 presently. The exemption that we have there is where you've got an arrangement that is in effect a financing transaction, in which case the standard then says the basic financial instrument shall be measured at the present value of the future cash flows discounted at the market rate for a similar debt instrument. Now this will apply both where the entity is the lender and where it is a borrower. So we then have to go back and measure either be the receivable or the payable that we have initially based on its fair value. So the initial measurement then of our basic financial instrument. A financing transaction may take place if payment is deferred beyond normal business terms or is financed at a rate of interest that is not a market rate, including interest-free loans. So therefore we must measure these items at fair value like I just stated. And IFRS for SMEs has got its own fair value hierarchy that is different from what we've grown accustomed to, where we have been applying full IFRS. The fair value hierarchy basically has three main things in it. Do we have a price that is quoted in an active market? If we do, that's always the best indicator of fair value. If not, do we have a price that has been agreed to in a binding sale agreement, or that has a price at which a transaction has been undertaken at, assuming that it's on an arm's length basis as well? If that is the case, we'll go with that. If not, then we're permitted to use other valuation techniques which would then estimate the price at which the transaction would have occurred in the marketplace. If none of these three are available or will work, then the standard says you can use cost when fair value is not reliably measurable without undue cost or effort. And in this case, undue cost or effort will take into consideration things like there may be variability in the range within which reasonable fair value estimates may sit, or you might find that there's probabilities of various estimates as to what fair value might be. So therefore, in this trying to assess what fair value is, we've got such a wide ballpark that it's next to impossible to pin down a number that is reasonable. We've got two sections that deal with financial instruments, Section 11 on basic financial instruments and Section 12 on other financial instruments. Section 12 then says, applies exactly the same principles and then says initial measurement of your financial instruments is always at fair value, which is normally the transaction price. In addressing subsequent measurement, it then says all items shall be measured at fair value through profit or loss, except equity instruments that are not publicly traded and whose fair value cannot be reliably measured without undue cost or effort, which are then measured at cost less any impairment. Same principles as we have with the basic financial instruments with respect to measurement. Moving on to associates and joint ventures and the accounting for such investments where they exist. An investment in an associate company or a jointly controlled entity is measured by using one of three methods. We can go cost, we can apply fair value, or we can apply equity accounting should we choose to do so. Now, whatever policy choice we make, we need to make sure that we apply it for all investments in associate companies, assuming therefore we say all associates companies must be measured at cost, then everything must be at cost. We could decide though for joint ventures that we would like to equity account all our joint ventures, and then all joint ventures will be on an equity accounted basis. We can't mix and match all in the same category between the three different methodologies that are available. Having said that, what the standard setters have done is they've specifically looked at the fair value model that is available under SME standard, and they said where you decide that you will apply the fair value model, initial measurement is always at the transaction price, excluding any transaction cost that you might have incurred. Subsequent measurement is at fair value at each reporting date, with any changes taken directly to profit or loss. Remember, we were applying the fair value through profit or loss model here. However, I've got an asterisk there next to the profit or loss statement that I've just made to you. And here, they brought in the fact that sometimes you may find that fair value is not determinable without undue cost or effort. So if I'm required to go and expend cost that is undue or is more effort than I can afford, then in that scenario, I am permitted to fall back on cost. Moving on to our accounting treatment for investment property. The definitions that we have for investment property remain exactly the same as before. Investment property is land or a building or a portion of a building that is held with the intention of earning rental income or for capital appreciation, or it could be for both, rather than for use in the production or supply of goods or services, or for admin purposes. So we were using the building ourselves as our offices, that would not qualify. Or if we bought the asset with the intention that we will sell it in the ordinary course of what we do, we happen to be a property developer and we will sell that building as part of our revenue generating activities, then that is not an investment entity either. Effectively, what you would be looking at if we met the first of the criteria would be owner occupied property. What's changed about the way that investment property is dealt with under IFRS for SMEs, the new version, is that because previously we were required to show any investment property that was carried at cost less depreciation and impairment as part of property, plant and equipment, the change that has now been made requires that such investment property is shown separately as a separate line item on the face of the statement of financial position. So therefore what they've added in is that where you show a reconciliation of the movement from one year to the next, is that any transfers to and from investment property that is carried at cost less accumulated depreciation and amortization becomes part of your reconciling items. Then that way we can then see the movement that's occurred during the year. Moving on to property, plant and equipment. An organization may elect to measure property, plant and equipment using either the cost model or the revaluation model. I mentioned this earlier on. Previously, if we only had the one choice, the cost model, if you do decide that you want to revalue your property, plant and equipment, then the application of this particular change will be on a prospective basis. And you would have to apply it to an entire class of property, plant and equipment. So if you decided that your land and buildings will be carried at revaluation, for instance, all land and buildings must be revalued. If you decided that you're going to do that for furniture and fittings, all furniture and fittings must be revalued. But you may decide motor vehicles, well, we'll carry on showing motor vehicles at cost less depreciation. That would not be a problem at all. Now remember, when one decides to revalue, that there are consequences that go hand in hand with revaluation. Revaluation is applied to an item of property, plant and equipment whose fair value can be reliably determined at the date of revaluation, and revaluations must also be done with sufficient frequency to ensure that the carrying amounts do not differ significantly from the fair value of these items from one reporting date to the next. So while the standard doesn't say to you, please revalue every 3 years, it certainly requires you to go back on a regular basis to go back and have a look to see, well, are the carrying values of the assets that we've got, do they more or less approximate the fair value of that asset? If they don't, then a revaluation is now required. Any increase in the carrying amount arising from revaluation are then recognized in other comprehensive income, as we mentioned earlier on. There's been another change to the section on property, plant and equipment, specifically dealing with spare parts and service equipment that may be carried on your balance sheet. That spare parts, standby equipment, servicing equipment, these items are carried as property, plant and equipment if they meet the definition of property, plant and equipment. Now folks, for you to meet the definition of property, plant and equipment is that asset must be of use to you over more than one accounting period. If the items do not meet the definition of property, plant and equipment, then, only then are they classified as inventory in the books. So if I've got a motor that is sitting in my warehouse waiting for a breakdown to happen, that's effectively an insurance spare, and you might find that in a lot of companies' cases, these items have been carried as part of inventory, part of stock on their balance sheet. These items are in effect property, plant and equipment because they meet the definition of property, plant and equipment, and therefore, if they do meet the definition of property, plant and equipment, they will be subject to depreciation and impairment and everything else that goes hand in hand with property, plant and equipment, all other property, plant and equipment that is carried on your statement of financial position. Another change that's been made to the standard is the accounting treatment for replacement parts. And it reads that replacement parts which add incremental benefit to an asset are added to the carrying amount of that asset. Now the carrying amount of the replaced part is then derecognized from the item of property, plant and equipment, irrespective of whether or not it was separately depreciated. You may find that you bought a packaging machine many years ago, and at the time that you bought it, you didn't separate out the various motors that make up this packaging plant from the conveyor belts, from the elevators and all sorts of other bits and pieces that make up this packaging plant. The fact that you're now having to replace a motor would in itself give rise to some problems. But this particular amendment to the standard hopefully clarifies what it is that we should be doing. And the standard says the carrying amount of the replaced item may be estimated by using the cost of the new item as an estimate of the original item's cost. So the motor that I'm replacing is going to cost me $10,000, for instance. And the one that was there was already 5 years old and would have lasted me 8 years. Then my assumption would be I would have depreciated this asset 5/8 of the way already, based on a $10,000 replacement cost. So therefore, that's what I'll then de-recognize the remainder of the carrying value of that asset, and then recognize the $10,000 I've just spent as the cost of the replacement part. There have been additional disclosure requirements that have been provided to the property, plant and equipment section of the standard, specifically to address revaluations. So where you do apply them, what is the effective date of the revaluations that you've applied? Did you use independent valuers? What methods and significant valuation assumptions did you apply in determining what the values are? And what would the numbers have looked like had the cost model been applied? And to the extent that you have a revaluation surplus that has arisen, are there any restrictions around the distribution of the surplus? To the extent that you are in a jurisdiction where there would be a problem with distribution of such a surplus, then you'd need to address this as part of your disclosures. The next item that is where there's been a change is around intangible assets. These are intangible assets other than goodwill. We'll deal with goodwill separately. Intangible assets can be acquired in one of 5 ways. Separate acquisition, the government gives them to you through an exchange of assets. They may be internally generated, in which case whatever cost we incur on that asset would be expensed. Remember, IFRS for SMEs has its own way of dealing with internally generated intangible assets, and these are always expensed. And then the last one would be around where you have a business combination. Now the standards provides us with guidance as to the initial measurement of each of these items. And while they're all pretty straightforward, where an intangible asset arises out of a business combination, the standard then says, please apply the fair value of this intangible asset. We recognize the fair value of this intangible asset at initial measurement. And then it hastens to say, unless the fair value cannot be reliably measured without incurring undue cost or effort. So again, you'll see another example of the concept of undue cost or effort being brought into the standard and dealt with specifically in the standard. Subsequent measurement of these items, these intangible assets that we've just recognized in our books. All intangible assets are deemed to have a finite life. The issue that arises with determination of the finite life of these intangible assets is, well, how long is this period? If the useful life of an intangible asset cannot be established reliably, then the standard requires that the useful life should be based on management's best estimate, which should not exceed 10 years. So there's nothing that stops you from depreciating your asset or amortizing your asset over a 15-year period or a 20-year period. But if you're not sure, then you can't exceed a maximum of 10 years. Just clarity on this particular point. And you'll see we'll deal with the same issue again just now when we start talking about business combinations and goodwill that arises out of a business combination. Now looking at the scope section of what is what goes into a business combination, there's been some clarification that's been provided in IFRS for SMEs around where we have a business when we have a business combination. Business combination, simply put, is one company goes and acquires another organization that meets the definition of a business. So basically, it's got inputs, it's got processes that can generate outputs, it can work on its own, it can generate its own income to settle its expenses. If you meet those criteria, chances are you have a business on your hands. Now the problem arises where you've got entities that are under common control. So you've got two companies that are coming together, but the ownership of these two companies before and after remains the same. Is that what we might have as a reorganization of a group of companies? So if that is the case, what is the accounting that we should be applying there? We currently don't have anything in IFRS for SMEs that gives us any guidance. So therefore we'll be required to develop our own accounting policy to deal with this. Now we may look to full IFRS. That will not help us much because there's no guidance there either. So we may want to look outside of IFRS and IFRS for SMEs for guidance on this. And we may look to UK financial reporting standards, US GAAP, and other standard setters that may have a similar accounting framework to what we currently apply as IFRS for SME reporters. When one looks at the application of the business combinations thinking, if I go and acquire another business, I'm required to identify the acquirer first as a first step. Once I've done that, determine who's acquiring who's in the zoo, who's being acquired, and who's the acquirer. Then the standard says determine the acquisition date, and this is normally the date when control passes. Sometimes you'll find that the lawyers will put in a date in the agreement, and it's backdated. Control did not exist at that date, so therefore one cannot use that as the acquisition date. But once we've determined what the acquisition date, hopefully it's a date that's current or in the future, then we go to the next step. Determine the cost of the business combination. What is changing hands? Are there shares? Is there cash? Whatever it is there going to be a swap of assets? All of that must be taken into consideration, and everything is measured at its fair value. Once we've done that, then determine what is it that you're requiring. So determine the assets and the liabilities that will arise as part of this business combination. And then we'll then compare the cost of the business combination with the assets and the liabilities that are being acquired, as well as the minority interests that may also be acquired, because I may not necessarily be acquiring 100% of an entity. I may be acquiring an 85% stake, and there's 15% minorities that arise, that will exist as part of that transaction. Now, if I look at my cost of my business combination, less my assets and liabilities that I'm acquiring, less my minority interests, the balancing figure that arises will either be goodwill or negative goodwill. The assumption here is I've identified every single asset, every single liability that should be sitting on this company's balance sheet. Now, in doing all of this, assuming that I'm happy to pay extra, more for the business than the underlying net assets are worth, inclusive of all my intangible assets that I've acquired, then goodwill will then arise. I need to then show that goodwill on my balance sheet, and in showing that goodwill on my balance sheet, my statement of financial position, I need to be in a position where I can justify why I was happy to pay extra for this, to acquire this entity. Sometimes it may work out that I pay less than the underlying net assets are worth, in which case I need to go back and check just to make sure that I have what I've acquired is I've measured the assets and liabilities properly, and that there is indeed a negative goodwill that arises on the transaction. So where I do have goodwill arising on the transaction, then the standard says to me, recognize the goodwill as an asset at the transaction date. I'm required to amortize it over its useful life to me, so I'll need to estimate how long that might be. And I'll be required to go and test that goodwill for impairment where there's any indicators of impairment, the same way that I would or any other assets that I test for impairment on my books. If I find that there's negative goodwill that arises on the transaction, the first thing that I do before I recognize this negative goodwill is I reassess my consideration, reassess my net assets that I'm acquiring at the initial point of acquisition, just to make sure that the transaction is giving rise to negative goodwill. If it then works out that there is negative goodwill, then any remaining excess I recognize in profit or loss immediately. So this negative goodwill is recognized in profit or loss immediately. Where I've got goodwill, then goodwill must then be disclosed in the financial statements. I must disclose the qualitative description of the factors that make up goodwill. So what are these expectations of synergies that I've got that I might have recognized as my goodwill? Or to the extent that I couldn't separate out intangible assets from goodwill, and I've lumped everything into goodwill, I'm permitted to do that under IFRS for SMEs, then I need to explain that. That's what I've done. When it comes to the impairment or the amortization and impairment of goodwill, we spoke about impairment already, but on the amortization, if the useful life of goodwill cannot be established reliably, then the same way that we treated intangible assets earlier is that we then work on the basis that the useful life cannot exceed 10 years. So work on management's best estimate, not exceeding 10 years. But if I can estimate the useful life to be 15 or 20 years, whatever the number may be, I can amortize my goodwill over that particular period without any problems at all. As part of my business combination exercise that I've undertaken, I will find that there may be certain numbers that will need to be remeasured. Deferred tax asset and liability positions, for instance, those will need to be rehashed in terms of section 29 of the standard. We'll get to section 29 later on. You may find that I may need to go back and revisit my employee benefit arrangements. Again, these may need to be recognized and measured again in terms of section 28 of the employee benefit standard. So this is just flagging it to you that there may be a need for remeasurement of some of these assets and liability positions that we have when it comes to the recognizing these items on our balance sheets. I mentioned minority interests earlier on. Your non-controlling interests are measured based on the non-controlling interest proportionate share of the acquiree's net identifiable net asset position. Now remember, this differs from what we have in full IFRS, where full IFRS allows us to use the fair value of the minority interest. Now in this scenario, given that we're applying IFRS for SMEs, the presumption would be determining fair value would be onerous, would entail undue cost to effort, so therefore it's not even on the table at all. So we simply work on the basis of, well, you've done a valuation of your net asset position. If your minorities own 15% of the business, what is 15% of that number attributed to them? And that's the end of that. So hopefully it makes it a little easier. The next section is on liabilities and equity. Just a few clarifications that have come in under this section. The definitions themselves don't change, exactly the same as we had them before, but I think it's the application of the definition where there's some clarity that's now been brought in. Equities, as always, is defined as a residual interest in the assets of an entity after deducting all of its liabilities. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the organization of resources that embody economic benefits. Again, none of that is new to us. Those are all things that we've known for donkey years. From a classification point of view, there are just some words that have now been added into the section on the classification of these financial instruments to enable us to make the distinction between when is an instrument a financial liability or when is it an equity instrument. And I think here it's important that we look at these words as they are, because I think that's where the explanation is. So in classifying a financial instrument either as a financial liability or as an equity instrument, one must look at the substance of the contractual arrangement, not merely its legal form, and in accordance with the definitions of a financial liability and the definition of an equity instrument. Unless an organization has an unconditional right to avoid delivering cash or another financial asset to settle a contractual obligation, then that obligation meets the definition of a financial liability. It's as simple as that. If an organization could decide that it chooses not to pay, not to settle an obligation in cash or in another financial instrument, then that instrument meets the definition of an equity instrument. So, when it comes to the classification of instruments, sometimes you may find that these instruments meet the definition of a liability but are classified as equity because they represent a residual interest in the net assets of an organization. So if I find myself in a situation like that, where I've got an instrument that entitles the holder to a pro rata share of the entity's net assets, or it's part of a class of instruments that is subordinate to all other instruments that are held on the company's balance sheet, or does not contain a contractual obligation for the organization to deliver cash or another financial asset, or the cash flows that will arise that will be payable to the holders of those instruments are based substantially on the profits or losses of the organization, then in that scenario, these instruments read like equity instruments. So therefore, they are then classified as equity instruments in the books. The standard then goes on to talk about some items that are classified as liabilities and not equity instruments, despite the fact that they may have features that may make them seem like they may be equity instruments. Instruments where participation in the net assets is subject to a ceiling. Maybe these items are not measured in terms of IFRS for SMEs, or they include a mandatory dividend feature, or you may find that it's an instrument that is, maybe it's an intercompany transaction, and when it comes to consolidation, this item is then classified as a liability on consolidation rather than as an equity instrument. These sort of things will then be classified as liabilities, even though the nature of them may make them seem like they're equity instruments. Standard also deals with members' shares in cooperatives, and says that these items are classified as equity instruments unless if the cooperative has an unconditional right to refuse redemption, or redemption happens to be prohibited by law, by regulation, by the entity's own memorandum of incorporation, its charter, or whatever it is that make the founding document of this entity. So any of those scenarios would then lead us to a different conclusion to what one might otherwise have come up with. Where an organization issues shares, Standard then says to us, those instruments must be measured at the fair value of the consideration receivable, net of any transaction costs, the only exception being a business combination, where we then look at the fair value of the items that are being received. If payment happens to be deferred and time value of money happens to be material as well, then the initial measurement must take into consideration the present value of the amounts receivable. What you may also find happens is that an organization may enter into a transaction where it extinguishes its financial liabilities by issuing equity instruments. Now, if this happens, then the entity may renegotiate the terms of such settlement with its creditors, and that may result in an extinguishment of its liability position, maybe fully or partially. The difference between the fair value of the equity instruments and the carrying amount of the extinguished liability must always be recognized in profit or loss. Now, you do this on the basis that you can determine the fair value of the equity instruments. However, if you can't determine the fair value of the equity instruments without undue cost or effort, then we assume that these are equal to the fair value of the liability, in which case there will be no transaction posted to profit or loss arising out of it. There are scenarios where we are not permitted to apply this. This is where the creditor happens to be a direct or indirect shareholder, acting in their capacity as a shareholder, or the creditor and the entity are controlled by the same parties before and after the transaction, or the extinguishing the liability with equity instruments happened to be part of the original agreement in the first place. Well, if that was the case, well, then chances are there was a formula that was determined in that particular agreement, and that must be taken into consideration. Sometimes we have non-cash distributions that are made to owners. Where an organization does distribute non-cash assets to its shareholders, it must recognize a liability for the dividends payable based on the fair value of the non-cash assets, take a corresponding debit to equity. Where the fair value of the assets cannot be determined without undue cost or effort, again bringing in the concept of undue cost or effort into here, then the liability is measured at the carrying amount of the non-cash assets. If it then so happens that fair value is determinable later on, then the liability and the amount that are taken to equity are then adjusted at that point in time. So effectively what we've got here is what we've got in one of the IFRS coming through now in IFRS for SMEs. Share-based payments are becoming more and more of a reality in the SME space. While they're not commonplace, they are certainly becoming a reality. And what's happened here is that the standard has been amended to take into consideration some of the changes that have been made to IFRS 2 in full IFRS that may be pertinent to share-based payment arrangements that are entered into by small and medium-sized entities. If one looks at the definition of what a share-based payment is, a transaction where an entity receives goods or services as consideration, and as consideration will issue its own equity instruments, or might issue share options in itself, or might incur liabilities to a supplier, to the counterparty, for amounts that are based on its share price or its share value. How these are then structured, we might call them options, we might call them share appreciation rights, we might refer to them as restricted shares, but all in all, at the end of the day, the payment that will be made is based on the value of the equity instruments of the organization. What wasn't clear before is what happens in a situation where An organization issues its own shares, but what it gets in return is not really clear. It cannot be identified. You'll find that in some jurisdictions, they have what they call affirmative action schemes. With affirmative action schemes, you might introduce a new shareholder into your business, and what they pay you in return for the shareholding that you give them may not necessarily be equal to what the market may be happy to pay for that same number of shares. You might also find that the shares may be issued to staff of the organization, and in return there is no cash payment that is made by the staff, or the cash payment may be less than what the company might have asked of a third party in an arm's length transaction. So if that is the case, the question then arose is, how do we then deal with the accounting in such a situation? And what they've clarified by making this amendment to the standard is that one must work on the basis of the fair value of the share-based payment, and have a look at the fair value of the identifiable goods and services that have been received or that will be paid, that will be received, measured at the grant date. If there is any difference, take that difference directly through to you account for that difference in your financial statements. If it happens to be a cash settled share-based payment transaction, then you'll have a liability, and that liability must be remeasured at each reporting date until such time that it is eventually settled. Sometimes the transactions that are undertaken involve group companies. You've got a parent company that settles an obligation that a subsidiary company has got. So the standard now clarifies that an entity that receives goods or services and another entity or another shareholder of any group entity happens to be the entity that happens to be the one that is settling the share-based payment transaction, that is still a share-based payment transaction. It must be accounted for in terms of the standard. Or you may find that the entity itself will have an obligation to settle the share-based payment transaction. One company within the group may have the obligation to settle a share-based payment transaction, whereas another company within the group receives the goods or services, the benefit that goes with it. That's still a share-based payment transaction, and it must be accounted for as such. Now the accounting is pretty simplified. For group share-based payment arrangements, group entities may measure the share-based payment on the basis of the consolidated group expense, allocated on a reasonable basis. What you may find is that head office or the holding company might issue shares to employees spread throughout the group, employed by subsidiary companies. Now you may find that depending on how complicated the group structure may be, one employee might work across 2 or 3 separate entities, or might contribute towards 2 or 3 separate entities. Now the question there arising on a scenario like that is, well, how do you then allocate the cost between all these entities on some sort of fair basis? And what the standard basically says to us here is that as long as you can demonstrate, as long as you can allocate the cost on some sort of rational basis, there's no right or wrong answer in terms of the way that you then allocate those costs. Just a bit of an overview in terms of the accounting that we should be applying. Equity settled share-based payments, fair values measured at the grant date only, and after that there are no changes that are then made to the numbers that were accounted for initially, or that were worked out initially. If it's a cash settled share-based payment scheme, fair value is measured at each reporting date, and any changes in fair value are recognized in profit or loss until such time that the instruments are the obligation is settled, instruments are exercised. Where you go cash alternatives, well then we work out, well, what portion of that is an equity settled component, what portion of that is cash settled, and then the accounting will then follow on from that. Moving on to income taxes. What we had what we've had in IFRS for SMEs was a fairly convoluted way of determining the income taxes and deferred tax positions that will be reflected in the set of financial statements. In putting IFRS for SMEs 2015 together, the standard setters effectively tore up the section on income taxes and replaced it with a brand new section that is premised on what we have in IS 12 in full IFRS. And that takes a simplistic view. If one compares the book value of an asset based on what is sitting in its financial statements, so the IFRS for SMEs numbers, you compare that against the income tax values, which is what the taxman would recognize for the same asset, any difference between those two positions gives us a temporary difference. One takes that temporary difference and applies the applicable tax rate to it. That will then give rise to either a deferred tax asset or a deferred tax liability, depending on whether or not the temporary difference that arises is a deductible temporary difference or is a taxable temporary difference. Now I'm going to talk about the tax bases in a moment, but before we do that, let's talk a little bit about the applicable tax rate. The applicable tax rate is basically the rate of tax that is either legislated or is substantially legislated at this point in time, substantially enacted, and will apply when it comes to the measurement of future taxes that will become payable or receivable by the organization. So to the extent that you live in a jurisdiction where once a tax rate is mooted, is discussed at a government level, that rate is pretty much going to pretty much stay, is what's going to be enacted when legislation is finally passed. Well, then you use that number. To the extent that there may be some uncertainty as to what the number may be, then we go with what's in black and white, what's in the legislation as things currently stand. So that's our applicable tax rate. Now to go back a little bit to the tax bases, we'll deal with the tax base of both an asset and a liability individually now. You look at the tax base of an asset, it's the amount that is attributed to that asset for tax purposes. So if I was to prepare a balance sheet for the taxman, it's basically the number that I would then show that an asset would be shown at on that balance sheet. So for an asset, it's the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to the organization when it recovers the carrying amount of the asset. Now, if those economic benefits will not be taxable, then the tax base of the asset is equal to its carrying amount. You'll find that in a lot of jurisdictions, things like Goodwill, for instance, one can't claim tax allowances against it. So therefore, what I would then show in my taxman's balance sheet would be a number for Goodwill, and that number will then will be exactly the same on both my accounting side of my balance sheet and my taxman side of the balance sheet, effectively giving me a temporary difference of nil for that item. When it comes to the tax base of a liability, it's the amount attributed to that liability for tax purposes. And the tax base of a liability is its carrying amount, less any amount that will be deductible for tax purposes in respect of that liability for future periods. Now we've got a bit of an issue here, a bit of an exception. Where you have revenue received in advance, in a lot of jurisdictions, the tax on that revenue is payable at the earlier of receipt of that amount or accrual of that amount. So now in this scenario, because I've received it before it's accrued to me, I'm taxed on it. So therefore, if I'm going to be taxed on it, then the tax base of the resulting liability that I've got in my that I'm going to show as my carrying amount, the tax base of the resulting liability is its carrying amount, less any amount of revenue that will not be taxable in future periods. So if I've already been taxed on it, then that means that in future, when the accrual eventually comes through, I won't be taxed on it again. So in that scenario, it'll then give rise to a deferred tax asset position of some sort on my balance sheet, because I'm paying the tax now before it becomes due. So I'm effectively prepaying the tax. When one looks at the issues that arise that would need to be borne in mind when it comes to determining our tax positions, we've spoken about the carrying amount of the asset. That's what we compute for accounting purposes. We've spoken about the tax basis. Sometimes you've got tax losses or tax credits that arise that need to be taken into consideration. Those will sit on the taxman side of the balance sheet. They won't sit on the accounting side of the balance sheet. So therefore, from a comparing what's on the accounting balance sheet versus what's on the taxman's balance sheet, take the tax losses and tax credits that are carried forward on the taxman side of the balance sheet. And those will then give rise to hopefully tax deductible positions going forward. We've spoken about the tax rates to be applied, and ultimately you'll find that where you've got assets that are carried at revaluation, which IFRS for SMEs now permits us to do, the rate that we may end up with may be a little bit confused. We may not know whether or not we should be using the use rate or the disposal rate. So what the standard then says to us is that in providing for deferred tax, work on the basis of what would happen if I was to sell an asset today. If I've got a revalued asset or an asset that is carried at fair value, if I was to sell this asset today for its current carrying value, what would the tax consequences be? So you may find that depending on the jurisdiction that you're in, there may be recoupment on some of the allowances that have been permitted against that asset, which will be taxed possibly at the full tax rate. There may be some capital gains taxes that may accrue as well on any capital gains that have accrued on that asset since you initially acquired it. All that must be taken into consideration at the point at which you compute your deferred tax. Where you got deferred tax assets, the thinking here has changed, gone completely roundabout here. Under the old version of the standard, we recognized our deferred tax assets in full and then wrote them down to what we thought we'd be able to realize. We're now taking a different view and recognizing our deferred tax assets to the extent that we think that we'll be able to utilize them. So there's no write-down that is happening. There's no provisioning that is being recognized against deferred tax assets. The accounting issues, we've dealt with some of them already. Revalued assets and investment property. Assumption is we've dealt with goodwill as well. And where you've got a transaction that neither affects accounting profit or taxable profit or loss at initial recognition, there shouldn't be any deferred tax impact on that. Whatever number we then calculate, we take that number as is. There is no discounting, no other changes that are made to the numbers. Recognize that number as is in your financial statements. And that will be the end of that. On the specialized activities, the changes that have been made are specifically around the exploration for and evaluation of mineral resources. So for the miners will generally incur expenditure on exploration. They'll do topographical, geological, geochemical studies. They'll do exploratory drilling. They'll trench, they'll sample. They'll assess technical feasibility of a piece of land or of a mining claim before they decide whether or not they will set up a mine. So if that's what we're doing and we're going through that entire process, IFRS for SMEs then gives us some guidance as to what we should be doing with this expenditure. It says exploration and evaluation assets, where these arise, are measured initially at cost. Subsequently, you account for these items as property, plant and equipment or as intangible assets. And you also take into consideration any obligations that you might have to restore a piece of land, so provision for rehabilitation costs, take those into consideration. And you also assess your assets for impairment if there are indicators of impairment. What they've done in putting this standard together is that they've now included these indicators of impairment more clearly. Maybe you find yourself in a situation where your rights to explore a piece of land have expired. That in itself is an obvious indicator of impairment. Maybe you're incurring expenditure in a situation, in a location where you don't expect that there'll be any more activity going forward. You're not planning on any more activity. You don't expect that there'll be any more benefit coming out of that particular area, and you've already incurred expenditure on it. That says to us that needs to be written off. Maybe exploration results indicate to us that whatever ore is under the ground is not viable. There aren't enough quantities of ore beneath the ground to make it profitable to mine. That in itself is an indicator of impairment. Indications are maybe that even if we go ahead and we put a mine in place, the expected cash inflows will not enable us to fully recover the expenditures that we've made on that mine. Again, all this is an indicator that we may have a problem, so therefore that would mean that we should be recognizing an impairment charge through our books. So I think while it may sound pretty straightforward, I think they've brought this in just to make sure that there's clarity as to when we should be able to, when we'll be required to test an asset for impairment, specifically in this space where there isn't a lot of guidance as to what miners can and can't do. Section 35 deals with the transition to IFRS for SMEs. And this section says, doesn't matter what it is that you're applying at the moment, whether you're an IFRS supplier, you're applying statements of GAAP, you may be applying your own accounting basis of your own basis of accounting, whatever it is that you're doing. If you take the view that says, I'm going to adopt IFRS for SMEs with effect from its effective date, which in this case is 1 January 2017. So I'm doing this for my 2017 year. Then we have to go through a process of first-time adoption of the standard. So what that then means is that if I've been reporting in terms of whatever GAAP, whatever generally accepted accounting practice I was applying previously in 2016, I would need to go back and restate those numbers. So I need to go back and restate the beginning of that period. So I need to go back to 31 December 2015 effectively, restate those numbers. That's my data transition to IFRS for SMEs. Go back to 2016, restate those numbers, and then the impact will have there'll be a cascading impact on the 2017 numbers. And the 2017 numbers will then be my first IFRS for SMEs compliant set of financial statements, and that I will have 2017 and 2016 numbers that are fully IFRS for SMEs compliant. The basic procedures that we'll need to follow in going through this entire process is that we'll need to recognize all assets and all liabilities that are required of us in terms of the standard, take off any assets and liabilities that are not required of us by the standard. There may be reclassifications that need to happen, items that have shown in the wrong places, maybe provisions that should not be provisions, that should actually be liabilities, or liabilities that don't really meet the definition of a liability that should be taken off the books. Those sort of things will need to be taken out. And then we apply the measurement principles that IFRS for SMEs has got with respect to the recognition and measurement of all these assets and liabilities that we're now showing on our books. There are what we call mandatory exceptions. These items we are required to make sure we go and have a look at these. So whether maybe there's financial assets and financial liabilities that don't necessarily meet the definition, do you recognize those? Hedge accounting that didn't really meet the definition of hedge accounting because not all the information or the documentation that we needed to have in place was in place. Take that off. Accounting estimates, maybe we've over-egged something and it shouldn't have been shown as a liability on our books, but we've shown it anyway. We may need to take that off. Non-controlling interest, the accounting for that, we might have done something different or not applied the same principles as we have in IFRS for SMEs. Go back and remeasure that. Then we have what are called optional exemptions. Here, this is where we can decide that, well, for some of these items, we will go back and we'll do what the standard says. Or if the standard may give us 2 or 3 options on how to deal with an item. Or it might say, look, whatever it is that you're doing before, carry on doing that. None of that has changed. It's all exactly the same. What's happened, though, is that there are some new exemptions. There's some new requirements that have now been brought into the standard. In the new requirements, they've now included the fact that you can be an adopter of IFRS for SMEs more than once. So previously, you could only adopt IFRS for SMEs once if you decided to move off it and you wanted to come back onto the standard again at some point in the future. Well, then you had to go back and treat the standard, treat your accounting as if you'd never moved off IFRS for SMEs. Go back and restate 5 or 6 years worth of numbers, and then at that point, you then say, well, I now have IFRS for SMEs numbers again. I can now start to move on. So when you decide to go this particular route and re-adopt IFRS for SMEs, you need to then disclose in your financial statements that that is what you've done. And you will be able to make use of all the transitional exceptions and exemptions that are available. They've also brought in some requirements on the accounting treatment for government loans. You may decide to use your previous generally accepted accounting practice carrying amounts for those loans on transition. It would not be a problem at all, even though that loan will be at below market rates, and you'll have to treat those items as government grants. You may also decide that you will, in applying the exceptions and exemptions, you may use an event-driven fair value measurement. Maybe you did a valuation in anticipation of a business acquisition, and those numbers were determined at or before the transition date, or they happened after the transition date, but during the period that is covered by the financial statements. You can use those numbers as a basis for the valuations that you include in your numbers. If an entity has operations that are subject to rate regulation, again, it may elect to measure its property, plant, and equipment and its intangible assets based on values that it would have carried in its previous generally accepted accounting practice. If you've done that, you don't need to apply that to all other assets that you own. You could do it to specific assets. You may then be required to test those assets for impairment, though, at the date of transition. But again, you'll see that it'll make your transition process that much easier. Sometimes you may find that the currency that you're using was subject to hyperinflation, so you may elect to measure all assets and all liabilities at fair value at the date of transition. Or you may decide, you know what, if the functional currency normalization date falls within the 12-month comparative period, you may then decide that you want to use a comparative period of less than 12 months. In which case you're permitted to do that, but you then have to explain that the financial statements are for a shorter period. There is going to be some additional disclosure that will be provided that you'll be required to provide in the financial statements where you do apply all these exemptions, such as the reasons why you stopped applying the standard in the first place, moved on to whatever standard you then started applying, and why you're now moving back onto IFRS for SMEs, and whether or not you have then gone through the entire process of being a first-time adopter, and if you've applied the standard retrospectively. The standard is effective for periods beginning on or after 1 January 2017. Early adoption of all the amendments was permitted. So I guess if you're still looking at year ends that are not that are earlier than 31 December 2017 at this point in time, and you wanted to apply IFRS for SMEs 2015, you certainly are permitted to do so. Application of the standard is retrospective. If there's any tax requirements, these will need to be applied prospectively. All amendments that have been made that you may decide to apply on property, plant, and equipment, and revaluing property, plant, and equipment specifically, those will be applied on a prospective basis. What we have, folks, that is what we have in IFRS for SMEs. If there are any questions, be happy to take any questions at this point.